All right, well, welcome back again. 5 Homes to Freedom, Module 4, and we are going to jump into lesson number 2, which is talking about reducing the mortgage payment in order to generate some cash flow for you. So let's take a quick look at how a mortgage actually works again. So, for example, if we have a $300,000 mortgage at a 3% interest rate, and it's amortized over 25 years, that's the life of the mortgage, that means our monthly payment is going to be $1,135.79. Now, when you do that over the course of the year, that means that the interest you pay to the bank for the privilege of borrowing that money is going to be $7,066.19. The balance of it is going to go towards reducing the debt, the amount that you borrowed from the bank originally. So your mortgage balance at the end of the year is going to be $300,000 less that principal reduction of $6,563.29. So that's how a mortgage payment works. And how it looks, when you take it and you put it into the mortgage analyzer, this is the normal mortgage paydown, you'll see that down here we have 300 months of your actual number of payments. So if you do nothing, you don't increase your monthly payment, you don't put any lump sum payments down, that means over the course of 25 years or 300 months, you'll have paid that debt off to absolutely zero. Okay? Now, you've got $664 in cash flow every month coming in. The question is, what do you do with that cash flow? So, in order to accelerate the mortgage paydown, what we teach in the 5 Homes to Freedom program, especially in version 1 of the program, is that we would apply most, if not all, of that $664. So in this case, we took $650 of it, and we applied it to the mortgage paydown. We accelerated the paydown. So we increased the monthly payments by $650, and what happens is it reduces the number of payments that you make on that mortgage over the life of it. So instead of it being 25 years to pay that mortgage off, it is now being paid off in 13.75 years. Now, with the 5 Homes to Freedom program, that's our goal, is to pay it off as quickly as possible. And that's why we look at other sources of income, other sources of money, chunks of money, to apply to that mortgage to get it down to 10 years, 8 years, whatever the model is that you're working towards. So that's our ultimate goal. But if you're focusing, you need to have some cash flow today, then an option is that instead of applying all of that $650 towards the debt reduction, you can apply a portion of it. So it's sort of a hybrid model. So in this particular case, if we only apply 50% of the cash flow, so half of that $650, which is $325, we apply that towards the debt reduction, and we keep $325 for our own personal cash flow to compensate or help us with our own personal living expenses today. That's the concept. What we've done, though, is we've increased the length of the mortgage up to 17.7 years. It's still better than the original mortgage of 25 years, but it's not as good as, just let me go back here, it's not as good as 13.75 years. So there is a cost of doing this. You just need to be aware of what that cost is to you and what the effect is. So the question is, how much cash flow should you actually take out? Well, it truly, I can't tell you what that number is because it's going to be different for each and every one of you if you decide to take it out at all. Personally, I would rather see the money be directed towards the debt reduction so that you can get the mortgage paid down as quickly as possible. So you have to ask yourself, when do you want to retire? Are you prepared to push your target date from, say, 10 years out to 15 years? If so, that's great. There's nothing wrong with that. And again, everybody's situation is going to be unique and different. It depends how old you are. So if you're 60 years old right now and you're wanting to achieve financial freedom in the next 8 years, you're not going to be able to afford to take cash flow out of the deals right now because you need to apply every penny you can find towards the debt reduction so that by the time you reach 68 years of age, you have an $8,000 a month cash flow. So everybody's situation, as I say, is going to be different. Then the next question is, how much cash flow do you actually really need? When I ask people how much cash flow they need, they'll throw a number out and they'll say, oh, I need $10,000 a month. I'll just sort of look at them and say, is that what you need or is that what you want? Oh, well, that's what I want. Okay, my question is, what do you really need? Well, what I really need, I could get by on $4,000. Okay, well, maybe that's what you do is you recheck what you actually need versus what you want, and you pare it back a little bit so that you can apply more money towards the debt and just take what you truly need out of the transaction. It also is going to depend on how many properties you actually have. So if your goal is to, or your plan rather, not your goal, your plan is to have 8 properties to meet your target, to meet your goal of financial freedom within 8 years. Well, maybe if you start playing with the cash flow from those properties, you're either going to extend that 8 years to maybe 12 or 14 years, or you just add 2 more properties to the portfolio and you keep the cash flow from those properties. Are there joint venture partners involved in the transaction? If there are, you're going to have to negotiate with your joint venture partners to see if they would consider allowing you to take a portion of that payment up front. And it's also going to affect the length of the pay down time for you as well. So these are all things you need to take into consideration, as well as if you're using borrowed money for the down payments, there's a cost to that, carrying cost for that down payment. That's going to come off the cash flow as well. So lots of things to consider, but it is an option that you can take if you need to. And maybe you only need money for the first year, the second year, or maybe you are in the plan and you're into year 4 when you get laid off from your job and you need to draw some of the money from the properties rather than use it for principal pay down. That makes perfect sense, and there's no problem with that. You just need to realize that by doing that, you may ultimately just be pushing out your end close date. And you just play with the mortgage analyzers and see what the effect is and see whether it's something you're willing to live with or not. So something to consider is just deferring some of the, or redirecting some of the money from the principal pay down into your personal bank account. But just understand there is a cost to doing that. It's a matter of whether you can live with that cost or not. All right, so that's it for lesson number 2. This is one of the shortest ones. So again, any questions, please feel free to reach out. Otherwise, look forward to talking to you at the live recording.